Welcome, everybody, to another Mortgage Insider edition here. And this week, we're going to be talking about something pretty cool and something that does come up often again in our industry. And that big thing is liabilities. So, as the viewers know, anyone looking to get a mortgage, things we're looking at is we're taking a look at your income, we're taking a look at your credit bureau. And within that credit bureau, it's going to be your liabilities. So, that's the debts that you have. And this can range from credit cards, existing mortgages that you have, student loans, lines of credit. So today we're going to really dissect into what that actually means for you. So Preet, let's start it off. What do you want to start off with?
Absolutely, Kim. Yeah, so welcome everyone. This is our another edition for Mortgage Insider Pass, let's say. And as Kim mentioned, liabilities. The other name that people use for liabilities is debt. How much debt you have in your daily life or monthly basis. This again really plays a very important role. How much debt you bring in, and we basically use it. Whatever you tell us or whatever the credit bureau report tells us, we use it to calculate how much maximum buying power you have based on the disposable income. So different type of debts are calculated differently, the monthly payments. In your eyes, it will be a different payment, like say a line of credit would be a differently paid monthly to the creditor, to the bank, to the issuing party. But on the calculation side, the banks and the insurance companies, they calculate it differently. So this is what both of us, me and Kim, will discuss in today's episode, and we will go from there. Right, Kim?
Yeah, and I think like to kind of dive into to Preet's notes there is like for an example, if it is like a credit card that you have or a line of credit, many of you may not know this, but I know the minimum payment on each of those is very nominal, right? Depending on
Mhm.
how much you owe. But in
Mhm.
the eyes of us, when we're reviewing to see how much you actually qualify for a mortgage, did you know that most lenders and most insurers, what they will do is they'll actually take a look at your balance owing and they're going to use 3% of that balance owing. So even though, let's say somebody has a credit card and their balance is, $1,000, their minimum payment per month is like $10, that's not essentially true. Right? On our end of the stuff, we're going to use 3% of that balance, and that's going to be used to actually qualify you for a mortgage.
Yeah. Yeah. So line of credits work the same way, just like credit cards, as Kim mentioned. So any outstanding balance that you have on your credit report for the previous month, but lenders will take 3% off that outstanding balance. So if you basically plan to pay it out in the current cycle and make it zero, then yes, we can ask the lender to remove that payment from the calculation. So as Kim mentioned, any outstanding balance on your credit card and line of credit is 3% off that balance.
hmm
Moving further, student loans. These are very common ones. Kim, would you like to elaborate more on student
Yeah.
loans?
So when it comes to student loans, funny enough, it's there's a lot of different ways that we can look at it, right? It depends on whether these are Canadian, the federal or provincial student loans, because that's calculated in a certain way, or are these actual student loans that are directed from a bank itself? Because depending on which type of student loan will depend what we use for the actual qualifying payment. So someone who has like a federal loan, most lenders will use anywhere between 1% to 1.5%, or your actual payment, right? If it's already in repayment status, lenders will use that to qualify. But if it is like an actual unsecured loan, or maybe it's just like a professional student loan, those qualifying criteria are a little bit different and it can vary from lender to lender. Um, the one thing to know is if it's not in repayment, usually, correct me if I'm wrong, but like we're usually sitting at the 1% for a qualifying
Absolutely.
payment, right? So,
Yeah, yeah.
so be careful on that, right? That's one thing to kind of be wary about.
Yeah. So if as Kim mentioned, if there is no payment showing up on your credit report against your student loans, normally lenders will use 1% of the outstanding balance as your monthly payment. They will assume that it is minimum 1%. So if it is $4,000 showing up, they will take 1% of that. And if there is a payment showing up on the credit report, they will use that payment. If it is higher than 1% or lower than 1%, does not matter. But if there's no payment, then 1% is the rule of thumb. But there are some lenders, mind you, there are some lenders who will use higher payments on the student loans also. So we
Mhm.
have to be very careful when we are sending an application to a certain lender. We need to know, and this is our part of our day-to-day life. Like
Yeah.
we need to
We gotta
know what other
assess.
lenders are doing, right? So yeah,
Exactly,
yeah,
exactly. And I feel like that's one of those things too for those listeners out there. If you have student loans, it's really even more important to actually work with a mortgage broker because keep in mind, we don't work for just one bank. We work for
absolutely.
multiple banks. So if in this situation your student loan could make or break your mortgage approval, go to a broker because then we can kind of see, all right, you know what? If we go to lender ABC, they'll only use 1%. Whereas if we go to lender J or something like that, they may use a little bit of a higher qualifying. These little nuances is very important, and that's why if your situation is a little complex, if especially if you have debts outstanding, work with a broker, right? There's lots of other options for us to explore. You're not just stuck with one bank, whereas
Mhm.
that could be very not beneficial for you at all. And I think like speaking on that note too, Preet, I get a lot of clients that will say, Kim, my student loan payments are zero, right? But just know that even if you're not in repayment, we still have to calculate something. And the same works for if let's say you have a credit card and you're going to get like 0% interest, there's no payments for the next 12 months. No, it does not work that way. In the mortgage calculation side of things, we still need to use 3% of that balance owing. Doesn't matter that
Absolutely.
it's a 0% loan, you not make no payment. It does not matter. In the eyes of the lender, debt is still debt, so we still need to use 3% as a qualifying payment for that.
Exactly. So what Kim is mentioning is deferred payments. So if you have any deferred payments on student loans or furniture loans or let's say electronics stuff that you buy from Best Buy, and they will say no payment for 18 months or something like that, we still have to consider it as a future payment. So rule of thumb again is 1% of that payment if it is not written on your credit bureau. Um, that relates to student loans and deferred payments also. But instead of a zero interest credit card thing, we have to take 3%. So simple as
Mhm.
that. Yeah. Moving further, Kim, I'm pretty much sure our listeners would love to listen about mortgages. And
Mhm.
many different times, I have many couples in my office, and they think that if they were on a mortgage previously, and now let's say, assuming only one applicant is going forward with a new application, and the second applicant is not going further, they think that the mortgage payment or the tax payment for that property would be reduced in half, 50%, but that's not the case, right? So I'm hoping
Totally.
you also had the similar scenario many different times.
Oh, tons. Yeah. And that's why, again, one thing I like to stress is if you've even thought about co-signing for someone's mortgage, just know that later down the road, when you go out to get your own financing, this very well can impact you because even though you're a co-signer and maybe, you're not even responsible for any of the payments, you're just co-signing to help a family member out or a friend out, it doesn't matter. In the eyes of the lenders, you're fully responsible for that. So even if you
100%.
don't pay anything, doesn't matter, right? They have to consider the full amount. Same thing if let's say, you are helping your brother or sister and you guys are paying 50-50, doesn't matter. Even though that you're on your own and you only pay 50%, they don't care about that, right? It's
Mhm.
on your credit bureau, it's on your record. So therefore, we have to include the full payment on that.
Absolutely. Yeah. So same thing. The common one we always see is clients have co-signed for their children or let's say siblings
Mhm.
for a car loan or car lease, and they always say, "I don't pay for this. My brother pays for this, or it goes through his account." It does not matter. As long as it's showing up on your credit report, you're responsible for that payment 100%. So that if these are the few things that comes to my mind right now when we are talking about liabilities, debts. The student loans are common, line of credits, Visa, MasterCard, credit card, mortgages, and deferred loans.
Mhm.
So if you have any other questions, you can feel free to call Kim or call me at the below mentioned numbers on the screen, and we would be happy to help you out. Kim, am I missing anything on the liability side?
I think that's it. And the biggest thing that we want to leave you guys, our viewers here, is if your situation is complex, if there is something that you want to run by us, give us a shout, right? That's
Mhm.
one of the benefits. Again, you need to have options because not every lender treats things equally. Hopefully, with
Yeah,
this, you kind of get like a little bit of a sneak peek, I guess, like a tidbit of what we do on our side in terms of a liabilities calculation. And I
yeah,
guess with that said, I think we'll catch you guys on the next podcast or the next video.
absolutely. Absolutely. Thank you guys for tuning in and I appreciate your support. Take care, guys.
Thank
Bye bye.
you.